The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A one-day rally doesn't make a trend, but a two-day rally, well, it does give hope for something better. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S.
Did I choke you up a little bit?
I know, a little bit. Because of this trend, right, that we have going on in the markets. Building on yesterday's 2.5% advance, the S&P 500 at one point did rise as much as 3.4%, but has really pared some of that advance back. You're seeing gains across the Magnificent Seven, with Tesla leading the way despite reporting its worst quarter in years. And of course, yields are falling at the long end of the curve, not so at the short end of the curve. So the 10-year now at 4.38%. And the Bloomberg Dollar Index building on its advance, its recovery from a 15-month low.
I'm kind of interested to see if the S&P can get back to that 5,400 level, because if it does cross that threshold, it might actually do something that it hasn't done in about 2.5 years, and that's post gains of at least 2% in back-to-back trading sessions. But while some investors out there are cheering what I guess can be described as a modest de-escalation of the trade war rhetoric, a lot of other folks are pointing to the economic cracks out there, including those flash PMI that we got this morning that showed activity in the U.S. services sector that actually slowed for the third month in the past 4. Complicating matters, well, is the fact that equity short interest has been rising, and that may have actually contributed to an upside squeeze today as well as yesterday. Average short interest for the Russell 1000 index, the largest U.S. stocks out there, that reached 14% as of yesterday's close. That's above the 10% mark that's generally considered the line in the sand for concern. So the question becomes, is the current two-day rally a springboard for a 4-day, a 4-week, or a 4-month rally, or is this just another head fake? The answer, probably in the money flows. Janice Henderson says that money is rotating to overseas, Europe, China, Middle East, and Latin America. In fact, the 10 best performing indices worldwide today are all outside the U.S. That includes Hong Kong, Germany, France, and a basket of emerging market stocks. Well, Scarlett, that's to erase all of its losses for the year.
Yeah, and that's pretty important context here, because the thinking is that U.S. stocks are still vulnerable to more declines as foreign investors rebalance their portfolios. And that is because foreign investors are very overweight in equities relative to treasuries. How much? Take a look at this chart. The blue line tracks the ratio of their U.S. stocks to U.S. Treasuries holdings, and you can see that their overweight is the most extreme since going all the way back to the 1960s. It's also well above the average. That's the yellow line there. Romaine mentioned Janice Henderson. The London-based firm said that signs of cracks in U.S. exceptionalism may lead them to cut their holdings of U.S. holdings by 10%, Romaine.
Absolutely, Scarlett, and it's not just stocks. So you're also seeing a similar move play out in the world of fixed income. In fact, you're seeing massive outperformance right now of local currency debt relative to dollar-denominated debt, and that could be a big factor in where we go next. Our first guest joining us right now to kick us off to the close is Stephanie Larosilier, head of fixed income business strategy and development over at Invesco. And Stephanie, I was just kind of taking a look at your recent calls here from you and your team here. You're still constructive on global bonds, but neutral on what's going on here in the U.S. Why?
That's exactly right. I think, when we look at the economic and geopolitical uncertainty that's taking place in the United States, it's really difficult to have compelling, argument for why one should stay in the United States in terms of investing at this point in time. I think, Janice's comments are similar. I don't think we're quite there, but we do think there are significant opportunities in international bonds, global bonds. In fact, when we look at our Invesco International Bond Fund, we've had a total return this year of just about 6%. Our Global Strategic Income Fund, a total return of nearly 4%. Meanwhile, many of the U.S.-based strategies are in flat to negative territory. So at this point in time, we just think that, the volatility in the U.S., the policy uncertainty really has to lead us to start to look at other areas of the market for investment.
I am curious, though, when you start to see the type of rotation that we've seen away from U.S. assets to foreign assets, do you see that as being something that's going to be long-lived? Or if we get a settlement of the trade war or some other encouraging signs here in the U.S., is all that money just going to snap back and come back to the U.S.?
I'm not sure that it'll snap back immediately, but we do believe that when it comes to what we're seeing in the U.S. markets, this is really based on a tweet by tweet, messaging by messaging that we're seeing coming out of the White House. As we've seen, we had the president walk back comments about Powell, walk back some comments about China and trying to find a sustainable tariff level there, and the markets reacted immediately. So I would say we're in a very tenuous space where things can go in either direction. We do think for long-term investors, though, the bond market is paying yields that we haven't seen in over a decade. When we look at, the corporate bond fund here at Invesco, we're paying yields of about 5.6%. Our high-yield muni strategy is paying 5.8%. That's a tax-equivalent yield of over 10% for high-income earners. We do believe that if you have, the stomach to wait and actually, weather a lot of this volatility that we're seeing in the U.S., there are some good long-term investments.
I want to go back to that idea that you find overseas markets more attractive or more appealing at this point, which makes a lot of sense given all the uncertainty is really rooted in the United States. But I wonder what's priced in when you look at both geographies. Feels like the base case in the U.S. is increasingly a recession, and you could say that stocks and bonds really reflect that. Is that the case for overseas bonds?
Overseas bonds are actually reflecting a slowdown. So we're not necessarily at a point where we're reflecting a recession. Here, our economists are now talking about a 45% probability of recession within the United States. Those figures are a lot lower when we look at a lot of the global landscape for bonds. So there's still slowing of growth because the tariffs will affect really all markets globally. But at this point in time, the U.S. is the most affected. And right now, 45% is kind of where we are in terms of the likelihood of a mild and shallow recession, albeit a slowdown.
And I think another base case is that everyone's saying to expect more volatility, to brace for more volatility, certainly in the U.S. While though there are those expectations of higher volatility, does that lead to more trading activity or does it lead to less? In other words, is this contributing to liquidity or is it draining liquidity?
We've actually seen the markets act in a more orderly fashion than we would have expected. I think, that was one of the things we were paying very close attention to following Liberation Day was just, were the markets going to get messy? Were we going to see more bid wanteds coming into the market? And we've seen a much more staggered approach and a market that has acted with liquidity. We've seen deals getting done. Although, we've seen slight premiums in certain areas. We've seen oversubscriptions of high yield deals coming to market. So I'd say from a market perspective, we feel like we're in an orderly place and liquidity is still there.
Is there any sense here, though, when we talk about where investors feel like they can find safety, for lack of a better word, Stephanie, is the idea that U.S. Treasuries, and for that matter, U.S. corporate debt as well, at least on a relative basis, would still be a more attractive option than the alternative?
We think more on a long-term basis. Right now, in terms of the Treasury market, we aren't necessarily looking that far out on the curve. But as it relates to corporates, I'll even bring, again, munis back into the conversation. When we look at, where we're starting this whole situation in terms of fundamentals, we started from a very strong standpoint. Credits have been sound. Credits have been very strong. We think that, if we can weather this storm in an orderly fashion, if we can get some negotiation and some resolution to the trade wars, we do believe that there is going to be continued value in the corporate market. We do believe there's going to be value in long-term U.S. Treasuries eventually. But as you said, in the near term, we do expect significant volatility. And we're seeing the volatility as opportunities, right? So I think, again, for those that have the stomach for the gyrations that this market is no doubt going to give us, we see this as attractive entry points.
All right, Stephanie, always a great conversation. Stephanie Larosilier, Head of Fixed Income Business Strategy and Development over at Invesco, as we kick you off to the close here on this Wednesday afternoon. A market still holding on to decent gains. And it's not the Trump bump, it's the Bessent bump. We're going to discuss why when Scott Bessent speaks, the market rallies. Libby Cantrill going to be joining us from over at Pimco.
Plus, we've got shares of Boeing taking off after its latest earnings report. How and when the plane maker expects to get 787 jets back to double-digit production rates. And as we keep an eye on corporate earnings and the impact of trade and tariffs, no company is at the center of this more than Whirlpool. That company set to report earnings after the bell. We're going to get instant response from Marc Bitzer, the chairman and CEO, when those earnings cross the wire. Stick around. This is The Close on Bloomberg. Headlines out of Washington are driving the stock market in a singular way. Just look at this chart that Renaissance Macro's Neil Dutta compiled. He used the NT function on the Bloomberg terminal, and the blue line tracks the number of mentions that Scott Bessent, the Treasury Secretary, gets in news stories. The white line, Commerce Secretary Howard Lutnick. The red line, Trade Advisor Peter Navarro. So Neil crunched the numbers and found that since the start of March, the S&P 500 has shed a total of 719 points on days that Lutnick and Navarro were the biggest story. When Bessent was the biggest story, the S&P 500 has advanced a total of 52 points. So Bessent helps support the market while Lutnick and Navarro are drags. Here with more on the intersection of policy and markets is Libby Cantrill, Managing Director and Head of Public Policy at Pimco. What does that chart tell you, Libby? What do those conclusions tell you?
Well, I mean, it tells you that obviously that the Treasury Secretary oftentimes delivers better news or at least less bad news. And I think what you have seen from the market recently is that the market is so hungry for anything that is not bad. And again, I think we can parse out what Secretary Bessent said today and also yesterday. It is nuanced. I think it was more positive news than negative. But again, for a market that is just hungry for sort of less bad news. But it wasn't an all clear. And I think this is the most important point, Scarlett, is that we have not gotten an all clear from this administration, particularly as it relates to tariffs. We are still facing the U.S. economy is still facing a very high tariff level, a lot of uncertainty as well, and that will obviously have implications for growth. But again, I think that chart tells you that at least Secretary Bessent is delivering less bad news than certainly Peter Navarro is. Yeah, less bad news is good news these days. And it does appear or feel like Peter Navarro is kind of sidelined for now, but that can always change given the administration. What are the conditions that you've observed in which Peter Navarro's perspective carries more weight than a Scott Bessent? I mean, what has to happen for Peter Navarro to be more influential on President Trump? Well, yeah, I think this is a great point because as there's a saying in Washington that personnel is policy. So the personnel who are talking, the personnel who are in the White House really do matter. In this case, though, with Peter Navarro, I think Peter Navarro very much shares the president's worldview on trade. I think they are actually very like-minded in terms of their goals of rebalancing the trading order, rebalancing the U.S. economy. However, then you have Secretary Bessent really talking about the practicalities of that, of those policies and potentially the practical and market limitations. So I don't think this is necessarily a total sidelining of the Peter Navarro worldview, because in fact, I think that worldview is really shared by the president. But I do think that Secretary Bessent and maybe Secretary Lutnick to a lesser extent sort of just show the kind of the market and the practical limitations of the implementation of that worldview. Well, speaking of that worldview, it's kind of interesting too. I mean, you have the IMF World Bank meetings taking place in Washington where effectively you get, probably close to 190 countries or the representatives of those countries descending on Washington. So an opportunity, if you will, for this administration to communicate directly with some of those surrogates. And I am curious, Libby, the messaging that we got today in that open session that Bessent had with the IIF, do you think that will be the sustained and consistent message to the world coming out of this administration? Yeah, I think that, again, that was a nuanced message. I mean, I think he absolutely did lean into the fact that the U.S. was really focused on rebalancing its economy and the kind of the global trading order, that the China exports too much and the U.S. exports too little, according to the secretary. So again, I think there was some nuance in what he said, but I think the fact that he did talk about that this was not America first, was not America alone, was very reassuring. Of course, this was on the heels of President Trump's statements yesterday that he was not going to fire the Fed chair. So again, kind of more good news, if you will. So I do think that this is, it is subject to change, certainly, but I do think that the overarching sentiment of they are very focused on this as a policy objective. However, there is some practical market and political limitations to all of it. So that gets to this idea then, as we get deeper into the actual implementation of these tariffs. Remember, a lot of them, of course, aren't even really enforced to a certain extent. Is there a sense here that you think that the president, if he is able to broker whatever kind of bilateral deals with these nations,
that would actually remove the tariffs, or are they just simply going to go down to whatever that bottom baseline 10% that he was talking about a couple of weeks ago?
Yeah, so that is actually our base case. Our base case is that 10% universal baseline tariff, whatever you want to call it, that is there to stay. We believe that is very sticky. That's something the president's been talking about not only for years, but for decades, having a universal tariff. So we think that sticks regardless of what the sort of trade negotiations, how those proceed. The sector tariffs, we also believe are going to be sticky. And then some of those China tariffs, we believe will be elevated. It was not likely to be that 145% level where they are now, but likely still to remain higher than they were, before the second administration of President Trump. So again, we think that all collectively is a pretty high tariff rate, kind of 15% or so. And again, what we're telling our clients is that even if we see some trade deals, see some positive headlines, focus on the signal, not the noise. And the signal is this has a real impact on growth and potentially on inflation as well.
All right, Libby, great stuff. Libby Cantrill, Managing Director and Head of Public Policy at Pimco, a closer look at what's going on in Washington and the ramifications for corporate bottom lines. One of those companies, of course, in the crosshairs of all that is Boeing. They came out with earnings, and, well, investors were pleased with what they saw. The shares rising for a second day after first quarter results beat expectations. A conversation with an analyst who covers the company and on why he sees headwinds and tailwinds ahead for the plane maker. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with Enphase Energy. Guggenheim cutting the solar equipment maker to sell and setting a street low price target of $33 a share. The analyst says the company's earnings report was worse than initially apparent. And it adds that weakening demand and exposure to potential changes with the Inflation Reduction Act could also end up hurting the shares. Those shares having their worst day going back to November of last year. Up next, Chevron, Redburn cutting to sell and lowering the price target to $124 from $156. The downgrade now makes Redburn the only sell-side shop tracked by Bloomberg with a bearish recommendation on the stock. And the analyst says it's not just a reaction to tariffs, but also a nod to an oil market in oversupply. Those shares fractionally lower on the day. And last, Cava. Bernstein upgrading the fast casual restaurant chain to outperform, saying the company is uniquely positioned to accelerate in a decelerating environment. And ahead of their earnings next month, the analyst anticipates Cava will be one of the few companies in the consumer space not to reduce guidance. Those shares rallying for a second straight day, and those are some of our top calls. Also rallying for a second straight day is Boeing. Those shares up 6% today after the plane maker reported first quarter results that beat analyst estimates, despite assurances from CEO Kelly Ortberg that the company will be able to navigate the current economic environment. The company still remains susceptible to the fallout of the trade war and has already had to stop aircraft deliveries to China. A complicated mix for the company as it tries to, stage a turnaround. Ken Herbert joins us right now to talk a little bit more about this. He's aerospace and defense analyst over at RBC Capital Markets. And Ken, I know the stock has gotten pummeled over the last couple of years, but it's actually one of the best performing stocks over the last, 2.5, 3 weeks or so. Do you see some sustainability in this? Is this at least the start of a better future for Boeing?
We believe it is. We do think we've seen a sustained turnaround, primarily driven by actions from the new CEO, Kelly Ortberg, as you indicated. But we'd also really point to three things. One, the demand environment remains very robust. I think travel is holding up relatively well, and the company has an incredibly large multi-year backlog. Second, the company is executing better. The company has delivered more MAX aircraft this year, 787s, and it appears to be on pace to deliver on the production rate increases it's talked about. And then third, the balance sheet has been significantly cleaned up. If you think back a year or so ago with where the balance sheet was, the company has significantly improved its position there, which has cumulatively helped to take some significant risk off the table.
Has the reputation of the company also improved, Ken?
It's a work in progress. I would say yes. The culture, reputation, these things take years, not quarters, to turn around. But I do think it's certainly moving in the right direction right now.
So the other thing that Boeing has to deal with, and there's a long list of things it has to deal with, is constrained production and, to Romain's point, questionable quality. The brand, the reputation is getting better, but it still very much needs to prove itself. It feels like in the global market. How long of a time frame should we be allowing Boeing for those things?
Yeah, it's a great question. You're right. It is, in a lot of regards, still a show-me story. The company continues to face issues with its supply chain. When you think about just the pain the supply chain has suffered over the last several years, certainly in the marketplace, it has significantly under-delivered aircraft, over the last 5 years for a number of reasons. So again, this takes time to work through. I think a lot of the signals we're hearing from the company today are incrementally positive. A lot of what you're hearing from airline customers and lessors, I think, is incrementally positive. So one day at a time. To your point, the company still has significant challenges and headwinds in front of it. But I do think with what it controls, it is executing better today. And we saw that with the first quarter results. And again, I think the company's moving in the right direction and addressing the challenges. But to your point, yes, these will take time and not something that's obviously fixed overnight.
Right. And in terms of controlling what they can control, we know the CEO, Kelly Ortberg, sold the flight navigation unit and some digital assets to private equity for about $10.6 billion in cash. How much more does it need to divest?
So I don't know that it needs to divest anything from a financial standpoint, and this obviously helps the leverage situation. This deal won't close that you just referenced until later this calendar year, so it's not done yet. But I do think from a strategic, focused priority standpoint, the company indicated today on its conference call that it is looking at some other portfolio shifts. So I wouldn't be surprised if there are other areas within the company that it deems to be non-core. The CEO indicated that he has completed his strategic review. So it sounds like there's a few more transactions like this to come. But obviously, from a financial standpoint, the company doesn't have to do these. But obviously, from a focus, culture, strategic standpoint, it's looking at some incremental actions.
All right, Ken Herbert, aerospace and defense analyst at RBC Capital Markets. Thank you so much. Yeah. Did I tell you that I recently flew on an Alaska Air 737 MAX, and it was the seat that didn't have the window? So I was like, really? This is the plane, this is the model, yes.
And you didn't get up and leave?
I was tempted to, but the flight was full.
Actually, it's probably the safest now, right? It's like usually it's after the accidents where things are usually the safest there. But I was just going to point out, too, I was actually kind of surprised at how strong the stock has been over the last few weeks. I mean, it hit a 52-week low, we should point out, just back at the beginning of the month. But since then, it's up 26%. It's the second best performer in the S&P.
Well, the bar is pretty low. The question is how much higher the bar has gone. We all like low bars, Easy to please in that way. All right, coming up, we are waiting for a flurry of tech earnings after the closing bell. So next up, we're going to speak with John Belton, portfolio managing and managing director for growth portfolios at Gabelli Funds, for his outlook on the tech sector, given all the uncertainty in the current market environment. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu. We're looking at gains across equity markets today. And Romain, the Mag 7 on fire, up about 3 1/3%, led by Tesla, up 6%, even though it had its worst quarter in years.
Well, I think the phrase you used in the last segment was a low bar. And there was certainly a really low bar for Tesla coming into this. And obviously some of the, I guess, euphoria, if you want to call a 6% move euphoria, is maybe the possibility that Elon Musk might actually go back to his actual day job.
Yeah, the fact that he said something about it, we talk about low bar, was relief for a lot of investors. That stock up 6%, even with that 71% drop in net income. All right, looking ahead to other earnings that we're going to hear from this afternoon, Texas Instruments and IBM all reporting over the next 30 minutes or so. So that's going to be really interesting as the tech sector picks up
research, service
more attention.
I like this lineup here because you're going to really kind of see who's really about
some
it.
Some hardware, some software, a little bit of everything. All right, so joining us now to discuss all of this is John Belton. John is portfolio manager and managing director for growth companies at Gabelli Funds. John, good to speak with you. You and I were just talking a little bit about how you made a lot of changes to your portfolio in the first quarter, but so far in the second quarter, you've really been sitting tight and trying not to overreact. How are you positioned right now for this earnings season for tech companies?
Well, it's been really tough not to overreact in both directions, really, because there's so much volatility in terms of the headlines. And it's really well-founded volatility that the market's displaying during this uncertain time. I think over the last couple of days, for the first time, we've started to see the market agreeing with some of what the administration has been signaling. Scott Bessent yesterday saying that the current trade situation with China is unsustainable. The market definitely agrees with that. So that's a positive. But taking a step back, at the same time, it's really unhealthy when you've got a market that's up this much today just on a comment that the president is not going to fire the Fed chair, and on the comment that there might be some hope that the situation with China de-escalates. So very unhealthy market backdrop right now. We're trying not to react too much. I think it's going to be a bit of a grind from here, but hopefully the selling activity or some of the more defensive moves we've done since the start of the year have come to pass.
Do you expect to hear anything from the CEOs on earnings calls that would propel you or compel you to make a decision to buy or sell their shares? Meaning, how transparent are they actually going to be with what they see out there and their level of confusion?
Yeah, I think there's a couple ways to answer that. I think, first of all, one healthy thing we've seen so far during earnings season is that in many cases, good results are being rewarded by the market. So that's a good thing. That is something that happens in a well-functioning market. Companies like Netflix beating estimates, tweaking the full year guidance higher, talking about a resilient business, that's being rewarded by the market. I think the other thing that's being rewarded that's been more clear the last couple of days is companies that are giving really honest assessments of the impact of tariffs and reflecting those assessments in updated guidance. That's being accepted, digested by the market. Many cases, like a company like GE yesterday, GE Vernova today, some of the healthcare companies that reported overnight, Intuitive Surgical, talking about here's the impact that we see from these tariffs, here's what we're doing to mitigate it, and here's the quantified impact on our earnings, and we're taking our full year guidance accordingly. So I think transparency is being rewarded and good fundamentals are being rewarded. That's two good news dynamics happening in the market right now.
I am curious, John, when we talk about some of the, overarching themes, structural themes that have kind of propelled the tech trade, obviously AI kind of all encompassing that, but on a more granular level, there was, of course, a lot of talk about the build out in data centers. And I know we've gotten some sense here that maybe that CapEx spend isn't going to be quite as high, at least in terms of what we've heard from Microsoft. And there was an interesting sell side note out from Wells Fargo on Monday that seemed to suggest that when we get results out of Amazon and some of the other hyperscalers, we could actually see maybe a rethink of that CapEx spend. Are you expecting that?
Well, I think, it's a really interesting dynamic right now. I think a lot of times in market environments like this, the market has a way of, spinning these narratives that things are really starting to fall off a cliff when the reality is just different than, stock prices would suggest. And I think some of that is going on with some of these, data center CapEx cycle exposed names. You were talking earlier about Tesla and kind of the beauty of having a low bar. I think you're seeing that in a couple of the data center exposed names today, like a name like Vertiv. It was a cooling equipment specialist for data centers, become sort of a token industrial AI name. They had solid numbers, good orders, and the stock is up significantly on that, being much better than feared. Couple other examples of that, but I do think, the comment you made about, some of these channel checks suggesting that some of the hyperscalers are pulling back spend. Mm-hmm. The companies themselves have come out and been pretty forthcoming about the fact that really is not true. Andy Jassy said in a shareholder letter a couple of weeks ago that Amazon is not pulling back on data center spend. And then AWS's VP of data centers said in a blog post yesterday they're not pulling back. So I do think the AI CapEx cycle is still very much alive and well. And there's plenty of AI investment that's still going into the ground, at least this year and likely for the years to come.
Yeah, and it's kind of interesting, too. I mean, you mentioned that letter from Jassy. I mean, it was relatively bullish when it comes to the longer term aspects of data centers and obviously what effectively the division he cut his teeth on with Amazon Web Services. As we get deeper into the earnings season, specifically in the tech space, John, do you think we'll see any sort of divergence in terms of the performance and, more importantly, the types of forecasts that these companies give?
Yeah, I think you have to kind of take it case by case. And I guess if we're talking mega cap tech here, there's a wide spectrum of companies in terms of how impacted they are by tariffs, how exposed they are to recession, how exposed they are to this AI theme. So I think, it really is a case by case discussion. I think on one end of the spectrum, you have companies like Apple and Meta and Amazon who have significant, first order exposure to tariffs, and specifically to China tariffs, whether they have customers located in China or they source product from China. So I think, there's a possibility that for some of those companies, these earnings act as a sort of a clearing event where, outlooks reflect the significant tariffs in place with China. And the significant impact those are going to have on some of these businesses. I think longer term, though, beyond just trying to make a call on what a stock does on the day of earnings, longer term, we do want to hear excitement about AI. We do want to hear commitment to investing in AI, and we want to hear about new AI use cases that are being discovered. And so I think we will hear that. I think most of what we're hearing about AI usage and AI use cases generally has been quite positive. So hopefully that is a theme that can sort of carry these stocks beyond this earnings season.
All right, John Belton, a portfolio manager for growth portfolios over at Gabelli Funds here. A closer look here at some of the tech earnings that we're starting to get. Of course, some of the big ones coming tonight out of Texas Instruments, Lam Research, IBM, and tomorrow we get Alphabet and a few others as well. When we come back, we're going to take a look at what's been going on in the world of biotechs and specifically vaccines. Novavax having a great day, up 16% after the company said it received some promising news about its next COVID vaccine. We'll discuss coming up next on our Stock of the Hour. This is The Close on Bloomberg. All right, time now for our Stock of the Hour. Novavax shares up about 18%, having their best day since February. This after the vaccine maker was asked by the FDA for more data on its COVID vaccine. The company's vaccine is already on the market under a conditional approval, but the update means that the shot could be headed for full approval. Joining us right now is Bob Langreth, who helps to cover this space for us here at Bloomberg. All right, so kind of break down. So the general idea is they were waiting for some sort of signal from the FDA. The FDA, are they asking them for more or not asking them for more?
So just give you some background here.
Yeah.
This is a non-mRNA COVID vaccine. This is the more traditional technology, Novavax. The clinical data is fine compared to the other vaccines, but it has this problem. The other vaccines have full approval. It doesn't. So they were waiting for that. There was a delay, and people in their stock went down. And sort of what's happened now, what happened today is Novavax gave a clarification that FDA is asking for more data, more clinical data, but a post-marketing data, like after they approve it.
Right.
And they said they think it's approvable. So that's basically a good sign that the FDA is apparently not asking for a new human study before approval. Okay,
so even though it's up 17.5%, this move only brings it back to its levels since late March, March 26th. So that's great context, Bob. Let me ask a really dumb question. Do people still get COVID vaccines anymore? Like, what's the demand for this?
Yeah, no, they're generally way down, but over previous years, obviously. And I don't have the latest numbers right in front of me.
People don't talk about it anymore.
But Novavax does have a new deal with Sanofi. Sanofi is going to take it over for next season. If they get this full approval, they get a milestone payment for Sanofi. This is a big deal getting this for Novavax.
There is, of course, the elephant in the room, which is, of course, the man who basically heads the main health agency here in the United States, RFK Jr., who is well known, being on the record as, let's just say, having some contrarian views when it comes to vaccines. Has there been any discussion that you've heard that vaccine programs, not just necessarily Novavax's, but all of them, could be at somehow risk for either being curtailed or even eliminated based on decisions that RFK
Well, I
made?
think this is kind of like a test case of how the FDA is going to handle, vaccines. This is the first test case,
Right.
One of the first under RFK. So investors viewed kind of this as good news. It's not like a whole new back to the drawing board study.
Well, just remind me, though, too, because RFK would generally have some degree of vetoing any sort of recommendation that came out of the FDA itself, the FDA staff and the advisors. Is that correct?
Technically, that's true. But technically, he's a boss. But the history is that, generally speaking, except for like the most politically controversial things, that the higher ups kind of leave the FDA alone, let the kind of the top experts make the decisions there.
Yeah, I can't remember. There was like one really great example of that several years back, where the HHS head stepped in. And was
we're in different times now, and everything's politically controversial. So
that's why I got a bunch of vaccines a couple weeks ago. Did I tell you this? Yeah.
Oh, I did. You were talking about old man shots, right?
The old man vaccines. So.
Yep, good idea.
So he's in good shape right now.
You don't have to respond to that, by the way.
Bob, what other drugs does Novavax have that can really give a boost to the top line and bottom line here?
Well, this is their main thing right now. Now they're working on combining it with traditional flu shots to do a combination vaccine. So this is, and they have other things in the pipeline, but this is like really important for them.
So it really feels like everything's riding on this one.
Sure.
All right. Bob Langreth, thank you so much. And again, Novavax shares really, really climbing today and remain looking at the volume. It's exploded compared to the 3-month average.
Yeah, I saw it was like, well, at least the 20-day average I saw it was like almost triple that too. So I guess it gives you a sense that, there is some euphoria here, but I don't know. Are you still getting COVID vaccines?
No, I stopped doing that a while ago. All right, coming up.
I'll remember that next winter.
Coming up, we're going to take you to the closing bell with Sarah Hunt, partner and chief market strategist at Alpine Saxon Woods. This is The Close on Bloomberg.
We think that, if we can weather this storm in an orderly fashion, if we can get some negotiation and some resolution to the trade wars, we do believe that there is going to be continued value in the corporate market. We do believe there's going to be value in long-term U.S. Treasuries eventually. But as you said, in the near term, we do expect significant volatility.
Stephanie Larosilier over at Invesco kicking us off to the close just about 50 minutes ago. Scarlett, stocks holding on to a decent portion of their gains on the day, but a little bit of a fade as we get closer to those bells.
Yeah, and you wonder if we've transitioned from buy the dip to fade the rally, given that the S&P 500 at one point was up by 3.4%, now up 1.7%, because there's more nuance offered by Scott Bessent on, the status of trade talks or the trade war and tariffs overall. What you pointed out earlier was also interesting, that this is a global rally, and we've seen global markets do incredibly well. The MSCI World Index, you can see there, up 1.4% on the day. And of course, that divergence in Treasury yields continues. Yeah,
and actually, you're seeing pretty decent outperformance as well. And in fact, I think when we finally tally up all the numbers for the month of April, we're probably looking at one of the biggest outperformances of non-U.S. stocks relative to the U.S. In several years, at least going back to 2020. As the market sort of tries to assess what the economic impact is going to be here in the United States from those tariffs, from the trade war, and of course, as Scarlett was referring to, some encouraging comments today from the U.S. Treasury Secretary. Sarah Hunt joins us right now. She's partner and chief market strategist at Alpine Saxon Woods, and she joins us here in studio too. And Sarah, I do want to start with those comments by Bessent, because there's been a lot of anxiety over an escalating trade war, a lot of anxiety over kind of the independence of the Fed. And Bessent addressed both of those things today, and he did so in a manner that at least seemed to give the market some degree of comfort.
I absolutely agree, and I think that the Q&A was important too, because it gave him a chance to actually answer questions as opposed to just having prepared remarks. And I think that the market was looking for something along these lines, because the reaction was quite quick and quite high, because I think that people have been worried, are we really getting to the point where we're going to fire the Fed chairman and go it alone and do all these things? And it was taking both of those extreme measures off the table. So I think it was important, and I think you can see that as the day goes on.
Off the table or pushed to the back burner for now?
Well, I think off this week's table and next week's table. The question is going to be, when does that come back? And we still have all these deadlines. Once we put those 90 days in, we have to go back and then see, okay, what exactly is 90 days and what's happening and what do we get in the interim? Because I do think that we need to see some deals that come out and some details in those deals that come out, so that at least we can say, okay, there's progress being made and this was not all for naught, really. And I think that that's going to be an important thing for markets to internalize and for investors to deal with.
Okay, so we'll be watching that over the next 2 months or so. But I guess given the commentary that's come out of the White House, did they basically just set a Trump put level? And if so, what is the asset class or security that you're watching for? And where is that put set?
Well, I mean, it's interesting because you didn't get a Fed put, right? And I think that that's where people are looking for this. I think we've looked at the lows that we saw somewhere around 4,800. We've seen some the highs that we saw in February. I think we're in a trading range. And I think that you can look at the whole piece, but the bond market is also important here. And we know that we have a lot of funding needs, and we know that we don't want to see yields on the back end going too much higher. As you saw a big relief in yields this morning. You saw bonds being bid. So I think that that was also really helpful. But I do think that there is still volatility to be had, and it's difficult to pick out which asset class because, as you mentioned earlier, this is a global phenomenon. What happens to the United States and its relationship with the rest of the world and its trading partners is important for all of the markets.
Is it fair to say there is an uncertainty discount to the U.S. now?
I think there's an uncertainty discount somewhat globally, but yes to the U.S. because we don't know what our policy is exactly going to be and how that dovetails with others. I don't think that the world can absorb a whole lot of goods if we're not going to take them. So I don't know that we may be focusing on the U.S. right now, but there is going to be a more global reaction to this if we don't get some certainty or some solutions in the next couple of weeks.
This gets back to this idea, and I know there's been a lot of talk about American exceptionalism and the fading of it, but there's also this idea that even as that exceptionalism fades, there's still this idea on a relative basis that we still, meaning the U.S., still ends up being the primary financial market. And I bring that up because at the World Bank and IMF meetings, there were several finance ministers, including from France and Germany, as well as the head of the Bundesbank, who were asked very specifically by our reporters about their support and, more importantly, their view of the U.S. dollar and U.S. debt. And it was pretty encouraging. And a lot of them basically made it clear that, look, the euro is not the reserve currency and is not going to be. And treasuries are still going to be the benchmark. And that in and of itself might be the market floor.
Well, it might also be stabilizing because, to be fair, you can see an intellectual argument why you could say the U.S. shouldn't be the reserve currency, but you don't really have a true alternative. There are arguments about why gold is going so much higher. There's arguments about why Bitcoin's going higher. But still, from a volume standpoint, you just cannot replace the liquidity and the size of the U.S., both treasury and equity markets. I mean, you take a couple percent out of the U.S. equities, you put them into Europe, that's a big move for Europe relative to a smaller move for the U.S. So the capital flows are important, but the U.S. capital markets are still the deepest. And I think that's where, again, you can see the intellectual argument, but the reality is there isn't a place that you can go.
Turning quickly to economic conditions and the bottom lines of corporate America, we're getting a lot of earnings reports already. And so far, some of the commentary on tariffs has been, if not encouraging, certainly not dour. And I am curious if you think that's going to hold up as we get deeper into the earnings season.
Well, I think the fact that there were meetings with some of the larger retailers, that there have been discussions among some of the players that really have a major skin in the game when it comes into the tariff, I think that's given some comfort. And I think that, Tom Keene always makes the point corporations will adjust, right? So there will be an adjustment. The question just has to be, what am I adjusting to? And since you don't know that yet, I am encouraged, however, about some of the stuff that we have seen because it has been stronger in some cases than people were expecting. And I think that that's good news since the market also is coming in fairly richly valued on an earnings perspective.
Do you see tariffs as a one-time hit to companies' earnings, or is this something that's going to be a more persistent drag?
I think it really depends on the company, and it really depends on what they're going to do. Because if you're going to shift buying things from one place to another, it's one thing. If you're going to make some investments in the U.S., that's a longer-term capex story, and that's going to have an effect on cash flows. But I think that there will be solutions. So I think that it's going to depend both from an industry standpoint and a specific company standpoint how those solutions are achieved and to what degree that's a timeliness, like I can do it quickly or it's going to take me a longer time.
Sarah Hunt, partner and chief market strategist at Alpine Saxon Woods, helping us count you down to those closing bells just about 3 minutes ago. And Scarlett, we've been talking a lot about the comments by Besson and sort of the idea that this rally is partly on the back of optimism when it comes to trade and the economy, but it was also based partly on some of the earnings reports that we got this morning. And we get a whole slew now coming after the bell as well, including from Whirlpool, Texas Instruments, ServiceNow, Lam Research, among others.
Right. And it doesn't really matter what happened in the first quarter. That's old news. It's all about how much they're willing to really share what their perspective is on the longer term, or at least in the near term. And that's the big question mark. There's no upside or very little upside to be too optimistic, and all the reason in the world to be cautious.
Also as reporting today, Alaska Air. I hear you have a close personal relationship with this airline.
Well, I flew on it recently on a Boeing 737
Were you going to Alaska?
No, I was going to California, so it's a little bit,
I guess that makes sense. All right, we're going to talk a little bit more about Scarlett's travels and break down all of today's market action with the global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlet Fu, taking you through that closing bell with a global simulcast that starts now. Carol Massar and Tim Stenovic in the radio booth. Alex Seal is on assignment today as we welcome our audiences across all of our platforms, including our partnership with YouTube, on a day where we're seeing a relatively strong rally, Carol Massar, for the second straight day.
Yeah, so good news, but we are well off our best levels of the session. But if you're something like a semiconductor stock, man, you are seeing some real big outperformance, up about 4%, off its highs as well, but definitely a big gainer in today's session.
Yeah, but let's talk about why this is happening. Optimism over comments from the Treasury Secretary and the President about progress between the U.S. and China. But is there any there? Do we know exactly what's happening? Do we understand what the trade deal or a trade deal will look like and how long it will take? I don't think we do.
There doesn't need to be a there for now. They just need to be saying the right things to signal to investors that things are not as dire as people had worried. The real focus is going to be on earnings and what the companies tell investors. And there's a Bank of America tidbit about how the ratio of positive to negative comments on macro conditions this earnings season is on track for the worst proportion since 2009.
Yeah, but it's kind of interesting, too. I mean, I did find some encouraging signs. And I know the earnings season is still young, but when you looked at what Boeing had to say, and I know that's more of a turnaround story, a little idiosyncratic, but that was encouraging. But also what you heard out of Vertiv and GE, Vernova, Otis, Thermo Fisher, and a few others, and AT&T, which, I don't know, is knocking it out the park for some reason. Everything old is new again. In fact, do you know this, Carol Massar?
What?
The number one performer in the S&P 500 today?
It's a name, yes.
It's a company that makes components for cable television.
And the ticker is APH. It's on my gainers list.
8.2%, front-running Carol Massar there. Let's get right to the numbers as we await a slew of earnings coming after the bell. The Dow Jones Industrial Average higher by more than 400 points on the day, or about 1%. The S&P higher by 88 points, or 1.7%. The NASDAQ Composite closing higher by about 2.5%. And the Russell 2000 holding on to most of its gains on the day, up 29 points, or 1.5%.
All right, well done, Mr. Bostic. Looking at the S&P 500, 361 names, guys, higher in the index.
It's just Romaine to you, by the way.
139 to the downside, one unchanged.
All right, taking a look at the IMAP, tech, consumer discretionary, and communication services. Those are the groups that the Mag 7 belong to, leading the way, all up by at least 2%. Your laggards today, those two thin red slices, consumer staples, and energy.
All right, quickly, in terms of some of the gainers, Tesla up 5.
Square pizza, maybe we can do that one.
The grandma's pie?
Yeah.
Love that.
Sorry, or rectangle.
Seriously?
Sorry. Keep going, Carol. We got earnings coming up.
Tesla up more than 5%. We know the deal. Elon's like, I'm coming back to the office. Top gain name in the NASDAQ 100 and the S&P 500. And let's go to the earnings.
All right, we are getting Texas Instruments crossing the wire. 1Q EPS coming in above analyst estimates, $1.28. The street on average was looking for $1.07. Total revenue in the quarter, $4.07 billion. The street was looking for $3.91 billion. CapEx also coming in relatively in line at about 1.1. And here's your forecast for the second quarter. The company sees second quarter revenue coming in at 4.17 to 4.53. The lower end of that range is above the average of street estimates. And on EPS, second quarter EPS of 121 to 147. The low end of that range is right on the nose of the average of street estimates. You see the market reaction there at the bottom of your screen, up 7.5%.
And the company also makes really clear that they invested $3.8 billion in R&D as well as expenses. They invested about $4.7 billion in CapEx and returned $6.4 billion to owners, presumably through share buybacks and dividends.
Okay, not getting a lot of commentary in the release. We're going to have to wait for the call to get some commentary, but worth repeating these numbers. The bottom line, first quarter EPS beating estimates at $1.28 versus estimates of $1.07. And then second quarter revenue, that outlook, as we heard, $4.17 billion to $4.53 billion. Estimates are for $4.12. So that beating estimates there. Shares higher right now by about 6%.
You know, what's interesting, too, is we were just talking with Angelo Zeno over at CFR Research, and he said, look to see what they say about China and their revenues, because that's about 20% of their top line numbers. And so whether or not they're seeing any kind of pain, but I got to say, these are really strong numbers. Yeah. Investors like it. Sorry, go ahead.
I am curious to kind of see what they say on the conference call. I mean, I was going through the release too. They don't really no mentions at all, at least not in depth, of tariffs and trade wars and all the economic conditions. So it'll be interesting to see what they say on the call.
Yeah, doing a search for the word tariff just does not exist. So it's a matter of how they, calibrate their responses. And I'm guessing a very non-committal and cautious approach, given what everyone else has said.
Well, there's a little bit of detail, not much. All of our markets grew sequentially with the exception of a seasonal decline in personal electronics. Seasonal, I don't know what that means. I mean, we do know what seasonal means, but is there something bigger happening there that we could say is indicative of the way consumers feel and the economy? We'll have to wait for the call to get details there.
I just want to mention another earnings if we could. I know this wasn't on our radar, but it's RHI is a ticker, Robert Half. It's a staffing company, and I've been paying closer attention to these given some of the concerns about the labor market and the economy. They did miss on several key estimates in their most recent quarter here. Revenue down about 8.5% in the quarter, and not quite seeing a forecast here, but they do kind of discuss a little bit some of the issues going on in the labor market. So something, a smaller company, but certainly something to pay attention to as we try to get a better read on economic conditions.
Yeah, no, absolutely. I mean, I just think every time a company, though, comes out and maybe is willing to actually make a commitment in terms of her revenue, that's a good thing, because we know that we talked to Gina Martin-Adams, and she said in her whole world of covering companies, she is like kind of amazed when a company puts out different scenarios, that she's never seen that. So here we have Texas Instruments talking about the second quarter. Once again, just to reiterate, second quarter revenue of $4.17 billion to $4.53 billion. The estimate is $4.12 billion. So that's pretty optimistic. And again, that's an outlook that company is willing to commit to, at least at this point.
Yeah. And again, the stock moving higher in the after hours trade. I want to go back to something you said, Romaine, about Robert Half and that idea that they're pretty much giving us a glimpse into the labor market as well. The revenue was down about 8% versus last year, but when it comes to the parts that really shed light on the labor market, contract talent solutions revenue down 14%, so double-digit percentage drop, and permanent placement staffing revenue also down about 10%.
Yeah, and this is kind of why I like earnings season, because it really does sort of create a situation where companies have no choice but to really put it all out on the line. As I know, we're getting other earnings out from Las Vegas Sands as well, Scarlett, Whirlpool, Lam Research, a few others crossing the wire. Scarlett, take it away.
Yeah, let's start with Las Vegas Sands. The casino company reporting first quarter adjusted EPS of 59 cents, beating the consensus estimate by 2 pennies. Net revenue for the period was a bit shy of analyst estimates, $2.86 billion. They had a first quarter adjusted property EBITDA of $1.14 billion, slightly higher than anticipated, and they approved increasing their buyback program to $2 billion. So that stock not moving a whole lot right now, up about 0.4% in after-hours trade.
Well, in after-hours trading, Whirlpool shares are up by 1.3%. The company did not change its fiscal year guidance. First quarter net sales coming in just shy of estimates at $3.62 billion. The company sees fiscal year revenue coming in at $15.8 billion to beating estimates of $15.72 billion. First quarter ongoing EPS coming in at $1.70. The estimate is for $1.72. The company still sees fiscal year ongoing EPS about $10. That beats estimates of $9.30. Shares higher right now by about 3.6%.
And we're going to actually have the CEO, Marc Bitzer, on the program right around in the next few minutes here. I just want to point out, too, there is some commentary in here about tariffs, and it's specifically focused on the idea of competition from Asian producers and the idea that there's been a lot of hoarding, if you will, here in the U.S. side of stuff from overseas. They're saying that's complicating factors and, a quote, amplified negative temporary impacts as Asian producers loaded U.S. industry in anticipation of tariffs in Q4. It also saying that the threat of retaliatory tariffs started to impact their business in Canada and in Europe.
All right, so some interesting context. You guys are going to warm them up for us, and then we're going to also talk to the CEO of Whirlpool. So looking forward to some of the commentary that he has to say about his world. Lam Research, I just want to pop over to that one because that one is also higher in the aftermarket. Third quarter adjusted EPS, $1 a share, 4 pennies better than what the street was expecting. The stock is up about 4.9%. Revenue, $4.72 billion. Again, that's a beat. It's up 24% year over year. Estimate was for $4.64 billion. And margins, adjusted gross margin, 49% versus 48.7%. So again, that's coming in better, and you're seeing, again, that stock pop up more than 4%.
Newmont Mining shares up in the after-hours trade, the largest publicly traded U.S. gold miner here. And if you've paid attention to the price of gold, well, you know how these earnings went. Sales up 25% on a year-over-year basis to $5 billion. EPS coming in at $1.25. You compare that to a year ago where they posted just 55 cents, and you compare that to the average of analyst estimates for the quarter of 93 cents. So a big beat on both the top and bottom lines. Not quite seeing the forecast here, but the big question is, how sustainable is this bump?
All right.
They actually just said they remain on track to meet their 2025 guidance. So the headlines continue to cross.
All right, let's also talk about IMAX, the movie company or the movie production company, reporting first quarter revenue, $86.7 million, does beat the average analyst estimate of $83.9 million. And the company is talking about in the release how it's done tremendously well by its global content slate, highlighted by a movie in China, Ne Zha 2, the highest grossing IMAX release of all time in China. It also captured 20% of the strong domestic opening for Sinners. I don't know if any of you guys watched that, but that was a big hit, apparently, for IMAX.
I'm too busy watching IBM shares move higher right now in the after hours, up 5.3%. The company sees second quarter revenue coming in above estimates at $16.4 to $16.75 billion. That beats estimates of $16.28 billion. First quarter revenue coming in at $14.54 billion. That beat estimates of $14.4 billion. It did reaffirm its fiscal year forecast. Once again, shares of IBM higher by about 5% in the after hours.
All right, quick check on Knight-Swift, the trucking transportation company. Total revenue for the first quarter, $1.8 billion. That's exactly what the street was expecting. Also looking, and let me just look at some other numbers. The year forecast still sees net cash CapEx about $570 million to $625 million. First quarter adjusted EPS, 28 cents a share. That's a penny better than what the street was expecting. And so stock, we're seeing just a little bit movement, but commentary about what they are moving or not moving around will be certainly interesting. So we'll look out for that. All right, guys. A lot of earnings. That's a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Tim and I are going to continue on Business Week, and Scarlett and Romain continuing there on television. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. A two-day rally for U.S. financial markets with the S&P rising 1.7% on the day. Add that to the 2% gain yesterday. Similar moves for the rest of the indices here. And you do get some modicum of maybe positivity, some modicum of optimism when it comes to asset prices. And a lot of that, of course, is built on the back, of course, of maybe a potential tamp down in some of the trade rhetoric. Of course, earnings has been a big part of the story as well, and we are getting earnings right now on Chipotle. Those earnings just crossing the wire. The company saying that in the most recent quarter, its revenue came in pretty much in line with estimates at about $2.9 billion. They also said that adjusted EPS also came in relatively in line at about 29 cents a share. The street was looking for 28 cents a share. We should point out, though, comp sales did actually fall in the quarter, 0.4% down. The street was actually looking for an increase in comp sales of about 1.74%. The company saying that for the full year, it sees comp sales growth in the low single-digit range, and comp restaurant sales also in that low single-digit range as well. We're going to get you some more details on that, with those shares moving lower in the after-hours trade. And that really is the backdrop, the setup for the next hour here on the close. And that is the health of corporate America. Earnings season is in full swing, and we did get some encouraging earnings report this morning from companies like AT&T, GE, Vernova, and even Boeing. But to a certain extent, those are turnaround stories, long-term stories that you don't need to account for some of the short-term economic disruptions. Maybe. The ratio of positive to negative comments on macroeconomic conditions during this reporting season has dropped to close to the worst proportion since 2009, according to Bank of America. Several earnings reports, they've already shown the difficulty executives are having in navigating the current trade and economic environment. We just got earnings out of Chipotle, IBM, Texas Instruments. We're awaiting Lam Research, O'Reilly, and a few others. But we also got Whirlpool. And Whirlpool is interesting because it's helping to provide a nice cross-section look at the state of the U.S. economy through the lens of corporate performance. And Whirlpool sort of reflects a bit of a dichotomy because it does have outsized exposure to overseas suppliers. However, the vast majority of the appliances that it sells in the U.S., they're already made here domestically. And maybe that suggests a smaller cost hit going forward from tariffs and a potential edge over its rivals. those earnings just out, and you see the reaction in the markets. And I'm pleased to say that the CEO and chairman of Whirlpool joins us right now. Marc Bitzer joining us here on Bloomberg. Marc, the numbers certainly good, particularly in an environment where I think everyone is expecting something bad. But I do want to start off specifically with the tariff situation and how you and your company are positioned to navigate to whatever those tariff levels end up being deeper into this year.
Yeah, so first of all, thanks for having me on the show. As you just pointed out, our Q1 was on track, and we feel good about where we are. I mean, both organic revenues are slightly up, and our earnings are pretty much on track. To your question about the tariffs, you highlighted already the most important thing is 80% of what we sell in the U.S. is produced in the U.S. I know very many companies talking about reshoring, onshoring. We never left. So as such, we are, no matter how you look at it, we're structurally a net winner of a tariff. Now, there's always two sides of the equation. In the short term, there are some what I would call manageable headwinds in the form of higher component costs. We also saw quite a bit of loading by competitors into the industry. But the long term, in particular, midterm, in particular, once the tariffs fully kick in, we are a net winner in this environment, and it helps our U.S. production.
Talk a little bit about, I guess, that pull forward, if you will. I noticed you highlight that in your press release that some of your Asian competitors, I guess a lot of those products were coming to the U.S. in anticipation of the tariffs. How much of a disruption or a distortion is that going to cause for your business?
Yeah, first of all, to give you a magnitude, we saw quite a bit of preloading. To put that in perspective, in Q4 and in Q1, the industry was roughly flat, plus minus. We saw the imports of all Asian producers into the U.S. in Q4 and the first 2 months of this year, we don't yet have a March data, up by 30%. Flat market, imports up 30%. So yes, I think that certainly meets the definition of loading ahead of tariffs, which also probably explains why I understand many companies are trying to press the pause button of tariffs. We actually would like to see them come in because the longer you wait, the more preloading will happen.
So on the flip side of that, of course, Marc, I mean, we talk so much about this tariff story from the U.S. side of the equation. There's still the issue of retaliatory tariffs, and we don't really have a clear idea of what that's going to look like. What type of exposure do you have to sales overseas that could be affected by retaliatory tariffs?
Yeah, so obviously there's a lot of moving parts in the equation, and we still don't know how it all fully plays out. First of all, keep in mind, if I look at our Latin America region, North America, we basically have region for region production. So Latin America produced for Latin America, North America for North America. So as such, we have a kind of a natural hedge, if you want to say so, against these retaliatory tariffs. Probably our biggest exposure is in Canada. I mean, Canada is a very, very important market for us. We're number one in Canada, and we export dishwashers, washers, and refrigerators from the U.S. into Canada, and we're right now exposed. I think, in the grand scheme of things, that's painful, but I think it falls under the category we can manage it as a company, because ultimately, with our U.S. production, we will benefit from closing some existing loopholes in the tariff landscape.
How much pricing power do you have right now, Marc?
Well, it's not so much a question of pricing power. In the pricing which we kind of announce and already communicate, we basically deal with a components element. I think the critical element is once this disadvantage which exists today, particularly on steel and components coming out of China, is kind of going away and the loopholes are closed, it will help loading our factories. We have quite a bit of installed capacity in factories in the U.S., and I think ultimately I would see the biggest benefit of getting the factories to good capacity utilization and gaining market share. So that's, I think, our biggest upside here in this equation.
With regards to that, there's been a lot of discussion that if economic conditions are softening, that a lot of people pull back on spending, particularly on big ticket items like appliances, unless they absolutely need one. Has that been a concern of yours? I know economic conditions right now are okay, but are you modeling for any sort of downturn?
Yes, I think it's an interesting point you're raising. I mean, we saw that, frankly, over the last couple of years. And to kind of put that in perspective, we have two components of demand. That's the replacement demand and the discretionary demand. The replacement demand, ever since COVID, has been very strong. And right now remains very strong. The soft part of the equation has been the discretionary demand, to the point where today it's about 65% is replacement demand and 35% discretionary. In the past, that was at best 50-50 or more, like 40% replacement. What we saw coming, it was interesting, kind of right after the election, actually we saw an uptick on the discretionary demand. But then coming out of, well, pretty much as of mid-February towards Q1, we saw with a drop of consumer confidence, we saw the discretionary demand again weakening. So right now, I think the only reason why the impact overall is somewhat limited is because the replacement side of demand is so strong.
Is there a sense, though, Marc, that when we talk about that replacement cycle, and I know to a certain extent your business is kind of tethered to a certain extent to home ownership and home sales, and there's been a lot of discussion about the slowdown there. Have you discussed this idea that if we don't see a material increase in housing transactions, that would limit how many appliances people are actually out there buying?
You know, I think we already saw the last 12 months pretty much the bottom of demand because it's replacement demand. So I think from here on now, housing is just upside for us. I mean, you know, it's kind of, last year, existing home sales, which are the biggest driver of our sales, more so than new homes. Existing home sales were on a 30-year low. And right now they've stabilized a little bit, but they're still kind of on a very, very historic low number. So from our perspective, anything happening now in the housing, hopefully at one point on the back of lower mortgage rates, that is just upside. And, we have a very, very strong business in the entire housing side, also with builders. We're extremely well positioned to benefit from that.
What about keeping costs under control? I mean, there was a report back in early April laying off about 600 plus workers at a facility in Iowa. Do you anticipate more job cuts, more layoffs?
Yeah, first of all, overall, as you know, I think we certainly have a reputation to be very cost disciplined. We know how to tackle costs, and we're right now, obviously, already with a softening environment, we were very disciplined in managing costs. But the Iowa one, which you mentioned, that was a line shift, and frankly, that is directly tied to what I mentioned earlier. You have a lot of Asian imports flooding the market with cheap steel, and that impacts our production load. So it's not structurally, but we just don't have enough volume to kind of support this line. And hopefully, once the tariffs fully kick in, that will change.
All right, Marc, really appreciate you taking time for us. I know you're busy. We'll let you get back to it. Marc Bitzer, Chairman and CEO of Whirlpool. Those shares higher by 4% in the after-hours trade. The company standing by its full-year forecast on the back of first quarter results that did pretty much come in relatively in line with street estimates. Meanwhile, IBM moving to the downside, down about 2% here. The company did provide first quarter results that were relatively in line with estimates, but gave a full year forecast and a second full quarter forecast that at least on the lower end of the range, causing a little bit of concern here in markets. Let's bring Amit Daryanani into the conversation. He's Evercore ISI analyst, director of equity research there. I am a little confused about the market reaction here, Amit. We talk about a company that, at least on the surface, when I look at these numbers, they're not awful, and some of them are actually pretty good here. What was the street expecting coming into this report?
Yeah, listen, the numbers are perfectly fine. There's a little bit of mixed dynamic at play. But the part I would tell you is this has been a very nice outperformer over the last several weeks, months, if you may, through all the tariff noise that's been going around. So I do feel like expectations were for a bit more picture perfect set of numbers from them. You didn't quite get that. And then at the same time, I'd say the consulting piece faded a little bit, so that's a bit of a negative. But I think numbers look fine. I think the bigger dynamic was the stock had a really good run up into the print, and you're seeing a little bit of that. The stock give that away right now. Are
you concerned at all that when you look at their major units, you're really only talking about one unit that actually had growth on the revenue side in the most recent quarter? You had a drop in consulting revenue, I believe, down 2%, a drop in infrastructure revenue down 6%, and then financing, which is a tiny part of their business, that was down as well.
Yeah, and software, to your point, did fairly well. It was up 9%. Now, if you look at the little bit of noise that's there, on a segment level basis, while the headline revenues look perfectly fine, infrastructure, while it was down 5-6%, actually did somewhat better than expected. So I'd say on the fringes, it seems like the mix went a little bit more hardware heavy, a little less consulting, and maybe a shade less on the software side as well. So that mix, I think, doesn't get people too excited either. You ideally want to see IBM, we think, beat more on software and consulting, less on hardware.
I want to read you a quote in the statement out of the CEO, Arvind Krishna, who talks about the AI side of this business and really the morphing into an AI business, and saying that there still is strong demand for generative AI, and that the company's book of business now stands at more than $6 billion inception to date, and that's up more than $1 billion in the quarter. Is that encouraging?
Listen, I think the future for IBM is going to be, they will be the enabler of AI as enterprises start to deploy it, right? And IBM's book of business was about $5 billion last quarter. It's went up to $6 billion. I do think AI will be a tool for companies to implement more efficiency in their organization. And much as what happened with public cloud, we think consulting is a way they're going to go unlock this AI tailwinds. And so we think a name like IBM will benefit in a tremendous manner over time. So I certainly think that AI signings is a good validation of where the long-term model is going. And IBM, we think, will become the AI enabler for enterprises.
All right. What do you want to hear on the conference call out of the CEO and the CFO?
Listen, I think the biggest thing you want to hear from them is just, the macro, the tariff uncertainty, what sort of impact is that having on their fundamental business? That's sort of one set of discussions. The conversion of the $6 billion book of business they have on AI, for example, how does that convert to revenues? What's the duration of that would be super relevant. And then are they seeing on the software side, very specifically, I would say, any dislocation, any slowdown because of the macro noise that's out there?
Amit, really appreciate you taking time for us. Amit Daryanani, Senior Managing Director of Equity Research over at Evercore. A closer look at IBM shares, which are moving lower here in the after-hours trade, despite a modest increase in revenue in the quarter, just about 1% higher than what it was in the previous quarter. But guidance here that causing some folks a little bit of concern. Meanwhile, we want to check in on shares of Chipotle, which also are moving lower in the after-hours trade, down about 4% here. The numbers there, well, a lot of concerns about a slowdown in same-store sales in the most recent quarter and, of course, going forward. Michael Halen joins us right now of Bloomberg Intelligence, who covers the restaurant space for us. Michael, what's the growth story here? Is there one for 2025 when it comes to Chipotle? I think we're having some issues. With his mic. I do just want to kind of walk through the numbers for just 1 second, because they are quite startling. Comp sales in the most recent quarter declined a fraction of a percent, down about 0.4% in the quarter. But the street was actually looking for a gain of about 1.7%. And that's a big part of the reason why you're seeing the shares lower. The company also gave a full year forecast of comparable restaurant sales growth in the low single digit range. Michael, you're back with us. Thanks for sticking with us here. Talk a little bit about that forecast, low single digit range. That is still growth. Are you pleased with it?
The story this year is slowing growth. That's been the issue with Chipotle. It's never a good idea to buy stocks when their top line and their bottom line are slowing, right? And they're kind of a little bit of a victim of past success. I mean, last year they put up great numbers despite what we're calling a restaurant recession, right? Across the industry, sales were weak, but not for Chipotle. And so that's where the concern comes in. I mean, they're ramping up net unit growth, which is a good thing, right? But, the question I think for investors right now, are they going to ever get back to that mid-single or high single-digit same-store sales growth, which becomes harder the bigger you get. It's just the law of large numbers.
Well, it's kind of interesting, too. I mean, at least if you look at estimates on the Bloomberg terminal, there is sort of an acceleration up in terms of growth rates that analysts have modeled in for the next few quarters, which I guess should be an encouraging sign. But I guess my question to you is, do you think they can actually meet those targets? And I know it's not the company's targets, but do you think they can meet what Wall Street is expecting?
I'd have to look at them. To be honest with you, results should improve. I mean, there were headwinds this quarter, cold, snow, one of the worst flu seasons on record. All of those things really hurt the restaurant industry. So I think investors are going to be very curious to hear what they have to say about April. We should see some improvement as soon as April. One of the bigger concerns I think about today's print really is that honey chicken didn't do as well as expected. I think that's what we're going to hear. I'd imagine that's what we'd hear after posting a negative same-store sales print and some pretty significant underperformance versus fast casual peers in the quarter.
All right, Michael, great stuff. We have to leave it there. Michael Halen over at Bloomberg Intelligence. A closer look at Chipotle, just out with its earnings. The share is moving slightly lower in the after-hours trade. Meanwhile, we're actually getting some earnings out of Southwest Airlines. They actually weren't expected to report until tomorrow, but they are out with their results. Operating revenue in the most recent quarter, a bit of a miss, $6.43 billion. All right, well, actually, I'll change that. It's basically in line with estimates at about $6.43 billion. The adjusted loss per share actually better than what the street was looking for, 13 cents versus 18 cents loss. The company, though, did say that it won't be reiterating its full year guidance for 2025 or its 2026 EBIT guidance. So basically the company's saying, look, we gave you our numbers for the most recent quarter. We can't really give you much more now. We're going to dive a little bit deeper into that and find out why this earnings report came out a few hours earlier than when it was supposed to. Meanwhile, some other breaking news, this involving the President of the United States and some headlines out of the Financial Times. The president now expecting to exempt car makers from some U.S. tariffs. This is according to reporting by the Financial Times. We're going to try to get you some details on that as we start to see a spike in some of the shares of U.S. automotive companies. This is The Close on Bloomberg. All right, welcome back to The Close. In the after-hours trade right now, automotive companies are spiking higher. In fact, some of the biggest gainers in the post-market trade. This after a report by the Financial Times that President Donald Trump is planning to spare car makers from some of the most onerous tariffs. Effectively, they're saying this would exempt car parts from the tariffs, as well as other destacking of duties involved with steel and aluminum that feed into the automotive space. This is according to two people with knowledge of the matter that did speak to reporters at the Financial Times. We are trying to get confirmation out of the White House, but let's go down to Washington right now, where Kailey Leinz, the co-host of Balance of Power, joins us right now. And Kailey, all day long, we've been talking about the appearance of a de-escalation in this trade war, with the comments by Scott Bessent a little bit earlier, comments by President Trump himself with regards to Jay Powell, and now this Financial Times story that we might be getting a walk back on the automotive tariffs?
Yeah, at the very least, a pullback on the margins, Romaine. What the Financial Times is reporting here is not a wholesale elimination on any tariffs that affect auto companies, but a bit of a reprieve when it comes to some of the specific strata of tariffs, if you will, that currently are affecting them, like the 20% tariff that has been levied on China specifically as it relates to fentanyl, as well as the 25% tariff that has been placed on steel and aluminum. According to the FT's reporting, the exemptions will leave in place the 25% tariff that Trump has imposed on all imports of autos into the United States, as well as the 25% levy on parts that is expected to take effect on May 3rd. So this isn't a complete elimination, if you will, of the tariffs that the industry has been grappling with, but does still grant them at least a partial win that they have been advocating for. As the president has made clear that he does want to have some flexibility, to use his language, when it comes to these tariffs, that he is willing to listen specifically to companies who come to him bearing feelings about this. That is applicable perhaps in the auto sector, but we're looking to technology as well, as he's made some suggestions that there could be talks with companies like Apple, for example, when it comes to some consumer electronics. As well as the retailers that he met with the White House earlier this week. Obviously, you're seeing some reprieve in the shares of these stocks. And I would point out, Romaine, roughly half an hour from now, the president is expected to sign executive orders in the Oval Office. It's very likely he could take some questions from reporters about this and potentially confirm this reporting from the FT.
All right, Must Watch TV, Balance of Power starts at the top of the hour with Kailey Leinz. We should point out Ford, GM, Aptiv, all moving higher on the day. But the biggest movers in that space are actually the car retailers, like CarMax up about 4%. And Carvana up about 2%. A lot of other earnings crossing the wire as well, including Texas Instruments, Lam Research, and Service. Now, let's get a roundup of what we learned out of Isabel Lee, Denitsa Sikova, and Alexandra Semenova. Isabel, take it away with Texas Instruments.
Here, Romaine, we're looking at Texas Instruments. The stock is edging higher by as much as 6% in post-market trading. This is the biggest maker of analog semiconductors. So the company reported better than expected earnings and also a rosy outlook. EPS came in higher than expected year over year and also higher than expected based on analyst estimates. Revenue was the same situation. It came in at $4 billion, and also operating profit was also a beat. As for next quarter, the company is expecting revenue between $4.17 billion to $4.53 billion. And this report is really one of the first that will come in the tech sector. And it's a promising sign for investors because they have been really looking at this industry, especially amid all the escalating trade war with China. Texas Instruments has one of the largest customer base and extensive product list. So it's really a good barometer of consumer confidence and demand. Still, though, we have demand slumping. We have the stock down lower, 20% year to date. But today is a good day. What are you looking at, Denitsa?
I'm looking at Lam Research. We're seeing similar trends. The stock is up about 5%. We're seeing a beat when it comes to revenue, earnings per share, and also guidance, which is something, unless we're very worried about with the escalating trade war, what we're seeing in earnings per share is $1.04, about 4 cents above Wall Street expected. And then for revenue, we're seeing $4.7 billion of revenue. When it comes to the outlook, the company is actually predicting higher revenue than expected, between $4.7 billion and $5.3 billion. Around 30% of their revenue was coming from China in this quarter. So you can imagine that's why we're seeing some pressure in the stock. Before that, we saw B. Riley and Barclays both cutting their price target. But overall, the stock remains a strong buy rating. About 70% of Bloomberg analysts have a buy rating. The stock is down 8% year to date, but today is bringing much needed relief. What are you looking at, Alex?
Hey, Denise, so I've got ServiceNow. This is the AI platform that aims to streamline digital workspaces. The company gave a sales growth outlook that topped Wall Street estimates. Of course, guidance has been so important this earnings season, especially at a time when the economy is threatened by tariffs. This is a sign that software demand still remains strong. And just looking at some of the numbers here, it kept expectations for subscription revenue, a key metric for the company both through June and for the full year, $3.03 billion and $12.7 billion. Both forecasts narrowly topping analyst estimates. Subscription revenue, of course, makes up the bulk of the company's sales. Shares were down about 23% year to date versus the S&P 500's 8% decline. And ahead of the report, JP Morgan analysts said that investors were too pessimistic on this company. Obviously, that is proving right. Right now, the stock is up about 9% in after-hours trading. And just a sign of what's to come, Romaine, options implied moves for this stock after earnings are showing a move about 8% the day after results.
ServiceNow, actually the biggest gainer in the after-hours trade, at least among large and mid-cap companies. Texas Instruments, your second biggest gainer, and Lam Research, your fifth biggest gainer here in the after-hours trade. Our thanks to Alex, Denitza, as well as Isabel for that nice roundup. Let's get right to Daniel Flax, because he joins us right now around the table here in Studio 2 to talk a little bit more here about the tech trade. And I do just want to get to a couple of lines here, Dan, with regards to what those three were just talking about. Texas Instruments basically saying they're seeing a rebound in industrial markets. Then you have ServiceNow saying that they're seeing resilient software demand. And then you have Lam Research saying something similar. We heard from IBM and a couple other companies. None of them seem to be saying that demand or their outlook is materially worse than what it would have been 3 months ago.
I think what's going on, Romaine, is that, first of all, with Texas Instruments, you've had inventory levels make a little bit of progress. ServiceNow, I think, remains really a foundational platform for companies that's helping them to re-architect a lot of their key workflows around operations, customer service, employees. And so these trends, certainly Lam Research in terms of the semiconductor capital equipment, these trends that are underway, I think, are very much intact. Now, the environment remains incredibly fluid, as we know, with tariffs, some of the cyclical cross currents, trade issues that are around. But what you see with these three companies, and I think more broadly with some of the other companies in the technology sector, an NVIDIA, a Google, an Amazon, a Microsoft, these companies are able to power through, in my view, be driven by their innovation, playing offense, if you like, while continuing to navigate what is a difficult environment.
A big part of that innovation, a big part of that offense over the last couple of years, as you know, has been this push into AI. And it was a trade that a lot of people were skeptical of. They said we were spending too much on it. The promises of AI were maybe a bit overhyped. I think it's kind of interesting that even the contrarians now seem to be kind of seeing the light. And that includes Cliff Asness, of course, a big one-time skeptic of machine learning. And now that he's become a believer. His firm, AQR Capital, is now actually betting on artificial intelligence and is raising external capital for two machine learning strategies. And I know Asness is just one guy amongst many, but he is a very important guy. And when people see what he does, maybe they want to follow. Is this kind of indicative of the idea that there is a lot more life left in this?
We think the trends around artificial intelligence have many years to go. Now, there's still cyclical dynamics at work, and all of these companies have product cycles. The spending can be inherently lumpy, and so that is going to continue. But if you step back and think about what's been going on, you've had companies like Google and Amazon using AI and machine learning for many, many years, infusing it into their products, their recommendation engines, delivering value to customers and shareholders. If we think about the next phase, though, with generative AI, it's really infusing artificial intelligence across a whole lot of different workflows. If you think about software coding, if you can become 20, 30% more efficient there. If you think about drug discovery, using AI to help with that. Fraud detection in financial services, climate change. So if you look across all of these different industries, generative AI and AI more broadly has a very big role to play, and that will, in my view, drive growth.
So it's kind of interesting you say all those things, because when we talk about the AI trade, we tend to focus obviously on NVIDIA being number one, and then Microsoft and some of and Alphabet and some of the hyperscalers. But a lot of what you talked about, those are companies, or the types of companies that would benefit from that, aren't even really in that top tier tech universe.
We think about it in a couple of different ways. So the enablers, NVIDIA remains an extremely valuable platform for its customers. They're executing well on key product cycles like Blackwell. The cloud companies, Microsoft Azure, Amazon Web Services, the Google Cloud, they're continuing to invest aggressively. And other companies in the retail sector, in the pharmaceutical sector, the auto sector, and so on through the all of the sectors are investing on these platforms to enable their businesses to adapt and grow in this next generation of opportunity.
Yeah. Are you not concerned at all, though, about some of the issues in Washington? The idea with tariffs and just policy decisions overall might end up being, if not an impediment, maybe a road bump, if you will, in terms of that AI trajectory?
I think some of what we're seeing out of Washington is causing a pause on decision making in many areas, and you're seeing that from companies as they're working out where to make investments, how to make further adjustments to their supply chain. I do think, though, that the technology itself is going to continue to move incredibly quickly. We saw DeepSeek out of China earlier this year. And regardless of the trade and the tariff changes over the next 12 to 24 months, the trends in technology, in my view, are going to continue and probably accelerate. It doesn't mean that these companies won't face the cyclical pressures, but the roadmaps, the technology roadmaps, the growth opportunities, and the ability to disrupt themselves and create value remains most important in my view.
So you're not worried about the AI bots taking your job, because that's always been the doom and gloom, right? Is the idea that as we get more adoption of these types of AI and ancillary products, that somehow that will put regular folks out of jobs.
The way I think about it, Romain, is that you have an AI as being a tool, something to help you do your job faster. The nature of work is changing. Think about how people have been using search engines for the last 10 to 20 years. You will now be using AI engines, if you like, to help facilitate things. If you can automate more processes, that frees up valuable human capital time to do other things.
Interesting. All right. Daniel Flax, Senior Research Analyst over at Neuberger Berman, and we're going to have a deeper conversation here about AI is affecting the workplace when we come back after the break. Stick with us. This is Bloomberg. All right, we were just talking with Daniel Flax here about the future of AI and how it actually affects the workforce. Well, the folks over at Microsoft, they actually just released their 2025 annual work trend index. And in it, here's what they have to say. They say that this year will be remembered as the year the frontier firm was born. That is the moment companies moved beyond experimenting with AI and began rebuilding around it. One of the folks behind that report joins us right now. Jared Spataro, Microsoft's Chief Marketing Officer of AI at Work, is with us. I had fun reading this report, by the way, Jared. I was a little scared as well, but I still had fun reading it. Talk a little bit about define the frontier firms, because our previous guest was kind of getting at that without necessarily using your language. Explain.
Yeah, indeed. Well, just backing up for a moment, this is our 5th year of doing this work report where we look at the future of work. We survey 31,000 people across 31 countries and then combine that with our own telemetry and the trends that we're seeing on LinkedIn to get a good sense for what's happening. Now to frontier firm. From our perspective, a frontier firm is a firm that is taking AI as its foundational element to produce value. And that means that they're building around AI. It's just an entirely new way to think about creating a company. And we're starting to see these being born across the world, across industries. So we think 2025 really is an important milestone.
There's been a lot of talk about how one of the real, potential utilities of AI is going to be the potential increase in human productivity and corporate productivity for that matter as well. Is there any way to quantify that, Jared? I mean, do we have evidence that that's real?
Absolutely. When we look at different patterns out there, one of the patterns that we see is, as you say, kind of assistive. It is a AI acting as an assistant, and there we're able to demonstrate that we can add many hours to the average work month. We can save people as many as 30 or 40 hours a month. That said, Romaine, the most interesting thing from my perspective isn't just helping people do what they do today a little bit better. It's actually reinventing work. And that gets to one of the stats in the report. 8 in 10 of the leaders that we surveyed actually told us that they think that 2025 is a pivotal year for them to entirely rethink their strategy and their operations. And then 82% of those leaders told us that they expect that they will add capacity to their workforce with AI agents in the next 12 to 18 months. So for the first time, you're going to see those humans and those agents working shoulder to shoulder, side by side.
I'm curious about this because I've heard a lot about this agent side, particularly out of, the agentic companies, like Salesforce, et cetera, that have kind of made it clear that they see this as a future. They also make it clear that the idea that these agents will be, I guess, completely autonomous in a way that we think about them in science fiction isn't going to be the reality, that either you need a human by its side or maybe looking over its shoulder, so to speak. Is there any worry, though, that AI, that machine, whatever we want to call it, could actually end up replacing that person who's by its side?
Well, it certainly makes a good headline, I'll say, because it drives fear. But we don't think that's the way the patterns we see developing right now are going to come to maturity. What we really see is that we see people continuing to be the driving economic force within a firm, and then they're using AI essentially to create what we call human AI teams, and in some cases to create human-led agent executed operations. Those are kind of two of the three phases that we lay out in the report, and we're already seeing signs of that today. But in every case, you end up having a human who really is playing a really pivotal role in guiding the way the company is actually producing value. So again, good headline. That's not the pattern I actually see.
Do you know how many companies are actually using this in some way in terms of the human agent type of collabs, if you will?
Well, so many companies out there are experimenting right now. The big difference is those who are turning kind of to be frontier firms. When we looked out across what we were finding, we found hundreds of examples across many different industries, in industries that varied from tech, for instance, all the way to manufacturing. So I don't have a percentage of all companies in the world, but right now it feels like people are really starting to move out of what would be kind of a little bit of the dabbling phase into a phase really starting to use it for production.
What about some of the more consumer-facing stuff, Jared? Because when we talk about agentic AI, it's kind of done through the lens of, what corporate America needs. So let's just take, if we take Copilot, for example, which is how most of us sort of interact with Microsoft's AI products here. Can just a regular person at some point kind of expect to also be aided by this agentic AI world?
Oh, absolutely. If you go to copilot.microsoft.com today, you can start to use Copilot to do all sorts of different things. It can help you complete tasks. It certainly can answer questions for you. Interestingly enough, one of the big top reasons that people turn to it is actually as a thought partner as they're working through things that are important to them in their lives. So, these tools are available. I would say that right now the limiting factor isn't the technology. It's just people learning to use the technology. We've got to kind of catch up culturally to what the tech can do.
Jared, really appreciate you taking time for us. A really interesting report. Jared Spataro is Microsoft's Chief Marketing Officer of AI at Work. A new report here on what the future of the workplace looks like, of course, with the integration of AI. Future slightly higher here in the after-hours trade on the back of several decent earnings. We're going to push ahead to what to watch over the next 24 hours, which includes more earnings out of Intel. This is Bloomberg. And as we work our way through earnings today, we push ahead to earnings out tomorrow. That includes from chip maker Intel, an early look at its new CEO's plans. This is Bloomberg reports that the chip maker is poised to cut at least 20% of its staff this week. Bloomberg's Sarah Fryer joins us right now, who covers big tech for us. And I know Lip Bhutan has only been in the job for, a month barely. But he's going to have to answer a lot of questions tomorrow. I was just looking at analyst estimates. We're talking about a 96% drop in adjusted EBITDA in the quarter and a 3% drop in revenue. What do you think he's going to tell investors tomorrow, Sarah?
I think he's going to try to buy as much time as he can to turn things around. I mean, it's been a company that's struggling to put products on the market that people want to buy in the age of AI. It really needs to revamp its product lineup. The fact that didn't happen quickly enough was why Louboutin was brought on, but these are products that don't just come in overnight. You have to really plan ahead for a long time to build up the capacity. So he's going to give them maybe a reality check, and I think they're going to give him some time because we may see some somewhat better numbers this quarter, just given that tariffs caused folks to buy up a lot of things and fear that they would get more expensive. So PC sales may have helped Intel this time around. Yeah. So that might buy him some time. But I think you're right. They're going to have a lot of serious questions.
I mean, he came into this job with a relatively decent resume, and a lot of people that had high hopes that he would have not just the managerial chops, but the technological chops to move this company to the next phase. Is this going to be an extension of what Gelsinger was trying to do, or is this going to be something completely new, basically his own stamp?
Well, I think it's going to take a lot of convincing for people to get on board with a completely new plan. But I think that what was happening before clearly wasn't working. The company wasn't making up for lost ground in the AI race. They really didn't have a product to bring to market that was good enough. So he's going to have to convince people that, maybe they were on board with that plan, but things need to accelerate. Things need to happen in a way that gets Intel back in the game and gets it back to a financially more feasible place.
All right, Sarah Fryer with the Bloomberg News, who covers big tech. Intel earnings out tomorrow. The street expecting roughly about $12 billion in revenue on the back of EPS of just 1 cent a share, a big drop from where it was a year ago. Meanwhile, we talk about some of the other things that could move the markets, and that includes a lot of earnings from a good cross-section of the economy. American Airlines, Pepsi, Keurig Dr. Pepper, and Procter & Gamble all set to report earnings before the bell tomorrow. And then after the bell, it's a refocus on tech once again. Intel, which we just talked about, but Alphabet also set to report there, an AI story and an advertising story all rolled into one. Skechers maybe providing some insights on the consumer. 8:30 a.m. tomorrow morning, we do get economic data out of the U.S., durable goods, and those weekly jobless claims. And at 10 a.m., we get those monthly existing home sales. So a hodgepodge of information that you put it all together maybe gives you a little bit more insights into what's going on in the economy as we wrap up our coverage here on The Close and push ahead to the things that have been driving this market. Once again, it is economic conditions, the tariff trade, and everything in between. You're looking at some of the after-hours movers on the back of earnings on your screen right now. A big drop that we're seeing there in IBM, a big drop in Chipotle. But look at that bid coming into Stellantis, up about 1.5%. It may not look like much, but some interesting headlines coming out of the Financial Times that the President of the United States may be willing to give a reprieve on those car maker tariffs. For more on that, stick around. Balance of Power is coming up at the top of the hour with Kailey Leinz. This is Bloomberg.